You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face.
All right. Hello and welcome. Step into the China shop, folks. Get on inside. We have another amazing, wonderful guest episode piping hot ready for you. As always, I'm Shopkeeper Dan. With me is Kyle, creator of financialineptitude.com. How are you doing today, Kyle?
I'm doing good. Excited about today's guest.
Yes.
It's not that often we meet a trader and kickboxer.
World champion, no less.
No, right? Twice.
Folks, we are joined by Derrick Oldensmith from T3 Trading. How are you doing today, Derrick?
I'm doing well, Dan and Kyle. Good to be here.
Tell us a little bit more about this kickboxing before we get too far into your background. I want to hear more about this.
Sure. So usually not what I end up talking about on, more financial related things, but it's a big part of my life. So I'm happy to do it. So it all goes back, I guess, about 30 something years ago to the Teenage Mutant Ninja Turtles.
Nice. Yes.
Are you familiar? You guys know them?
Oh, very familiar.
100%. Which turtle were you?
Heroes in a half shell. I was a big Donatello guy when I was a kid.
Me too. Yep.
I was a Raphael guy.
So you're a tough guy, huh?
I'm a hothead. Yeah.
So, I mean, basically I was a kid and I was into the Ninja Turtles and I begged my dad to sign me up for karate lessons. Mm-hmm. And this is, late 80s, early 90s when that was really cool. And
Karate Kid
and all that stuff. Mm-hmm. That's right. So it just so happened that the local martial arts dojo was headed up by this guy, Master Bob Morrow, who himself was a former world champion kickboxer and has trained, probably 5 or so professional kickboxing champions, world champions over the course of his career. So I got started just with the basic martial arts aspect. Was really into that when I was a kid. In high school for a little bit there, a couple of years, I was like too cool for karate type of thing. Mm-hmm. But I missed the sparring aspect, putting the gloves on and being able to punch and kick. So I went back to the gym one day and I was like, hey, can I come back to spar? And it just so happened that this guy, Chris Algieri, who was he was at that point, I guess, champion of the United States, eventually becomes a 2-time world kickboxing champion, then segues into professional boxing, becomes a professional boxing champion, fought Manny Pacquiao for however many millions of dollars that payday was.
Oh, wow.
And he needed sparring partners. So I was like, okay, I'm happy to be the sparring partner dummy for this guy. Exactly. Yeah. The punching bag. And most of his sparring partners wouldn't come back because he would whoop their butts so hard.
Right.
And for me, I would get beaten up and it just motivated me. I wanted to get back in there. I was like, man, if I could just land one punch on this guy who's a professional fighter training for, world titles, if I could just get one punch on him, I want to do that. Mm-hmm. And so I kept coming back. And then eventually I was like, well, maybe I should do an amateur fight since I'm sparring in the gym all the time anyway. And the amateur fights were so easy after sparring, professional world champion.
Right.
So I was undefeated as an amateur fighter, won some amateur belts, and then in 2009 I turned pro.
Wow. So
I fought professional kickboxing for about 10 years or so. I ended up having a total of like 40 fights or so. The majority of them were W's. Eventually won 2 world titles myself. And it's been a big part of my life. And it's actually been a big part of my trading career also, because I think that one of the reasons why I've been able to be successful in this business was because I have that martial arts background with the discipline that's required to be successful in it, and the motivation of you get hit in the liver and you get knocked down, you got to get right back up. Well, if you've been trading for as long as I have, I promise you're going to get hit in the liver a couple of times.
Yeah. Oh, those liver shots are rough.
Yeah.
Let's put a pin on that because I definitely want to come back to how the two tie together, because I think I hear a lot about prop firms, like they like to go after former athletes and poker players.
Yep. It's definitely something that, I'm on the recruiting side also of T3 Trading Group. I've been here for 12 years. I've been managing professional traders for the company for the last 9 years. That gave me the opportunity to start my own trading desk back in 2013. So I definitely get my fair share of resumes that I look through. And, whenever I see that athletic background or, a background like poker, which I personally never played, but I understand that it's a game of probabilities. If you've got that kind of mindset, you can be successful at those things. You really can translate that over, I think, into trading.
You mentioned T3. That's can you tell us a little bit more about your trading group?
Sure.
I see that it looks like you guys offer education and some other stuff too, as well as like a virtual trading floor. I'm curious what that means.
Sure. So T3 has a parent company that's called T3 Companies, and there's a bunch of different sister companies underneath that, like T3 Trading Group, which is the FINRA registered broker-dealer. It's a professional trading company that engages in prop trading and retail trading. We have T3 Live, which is our education and media company. And then there's some other sister companies like, T3 Technologies, which is involved in, black boxes and HFTs and things like that. My primary focus with T3 is with T3 Trading Group and with T3 Live. T3 Trading Group is where I've been for since 2010. I've been there for 12 years now. Mm-hmm. So I first started with the company as just an entry-level proprietary trader focused on equities, and was able to do okay for myself in the beginning. I thought I knew a lot about trading in markets before I joined T3. The truth was I really didn't. I was into a rude awakening there. But I was able to understand early on that the key to this business is risk and money management. Mm-hmm. At the end of the day, I tell my traders this all the time. At the end of the day, we're really playing a math game. All you have to do to be successful, it's as simple as making more money than you lose.
Right.
Or I guess sometimes it's as difficult as making more money than you lose, right? But I did understand that early on in my career. It enabled me to keep a good lid on the downside when things didn't go well and have some small, consistent success that I worked on adding scale to over the years. And as I was saying before, it eventually led to the opportunity where I got to start my own trading desk in 2013. It started as me and two other professional traders. Mm-hmm. I've been able to develop that into what has become T3's largest group of professional traders. I currently am directly managing a little over 150 professional traders on a day-to-day basis. I think that's the number now. Oh, wow. The main way that I was able to develop the group of traders that I'm working with to this size and scale is because I created a lot of infrastructure for the training and development of the people that I work with. Mm-hmm. So every day I conduct a morning meeting at 9 a.m. Eastern, an afternoon meeting at 10 after 4. Every afternoon meeting ends in a group Q&A session. I created training programs. Everyone gets access to this virtual trading floor software that T3 Live created. And by putting all that stuff together and by having success with the team that I was working with, it enabled me to expand what I did at T3 to get more involved with T3 Live, which is that education and media company. They said, hey, Derrick, you're already training professional traders. Why can't we translate that into the education and media offerings that T3 Live has? Mm-hmm. And things have gone well. Eventually, in early 2020, T3 Trading Group put me in charge of business development for their equity and equity options business as a whole. So that has me in touch with all, I think we've got 500 plus traders overall at the company on a professional side at this point. Wow. And this is all, by the way, while I'm trading myself. Right. So they keep me more than a little bit busy because I am to this day a pretty active equity trader. I day trade, I swing trade, I have a quantitative strategy I developed to implement by hand as the market on a day-to-day basis. Time frame for my positions will be anywhere from minutes at the shortest to over a year at the longest if things line up properly. Mm-hmm. And I have a heavy focus on technical analysis, but I also do incorporate fundamentals with what I'm doing. Oh. So hopefully that's the overview you're looking for.
So a little bit of both. Seems like the TA guys don't like the fundamentals guys, and vice versa.
Isn't that the truth? And to me, that's always been the most bizarre thing in the world. You mm-hmm. can name almost any trading strategy, and you can find someone who has been extremely, extremely successful at that. Right. You look at how can you tell me fundamentals don't work when Warren Buffett exists? Right. Yeah. And at the same time, how can you tell me technicals don't work when a guy like Paul Tudor Jones exists or Stevie Cohen exists? Mm-hmm. Obviously they do. So I actually love to combine both. I think that fundamentals can tell you what you want to be involved in, but it's the technicals that tell you the timing on when to get involved, how to manage the risk in case you're wrong, and how to manage your reward for when your opportunities work out. Mm-hmm. Let's take a step back on. You mentioned that you started out kind of trading, and then you got hired in with the prop firm and started doing some of that. What was like the main difference? Because you said you thought you knew a lot until you started trading for somebody else professionally. Like, what were some of the big shocks or the big differences? Sure. So I actually bought my first stock when I was 13 years old. I bought $500 or so worth of Nike stock based on mm-hmm. money I had saved up. And I became fascinated with this market ever since that point because I used to do these kind of dirty jobs like helping my dad pick up litter in the parking lot of his business for $1 here or $1 there, to all of a sudden seeing how money can make money for itself. I was fascinated with that.
Right.
So got into college, and then, typical broke college kid, I certainly didn't have too much money. And, probably 2006 or 2007, something like that, I started to have just a little bit of side cash. And I said, hey, let me invest this money. Let me start a journey here, because I knew by that point I wanted to be a trader. Mm-hmm. But, if I want to be a trader, well, I better get involved in markets and start learning a little bit, right? Because school's only going to teach me so much.
Right.
So I think it was in 2007. It was when the market was near its top before the financial crisis.
Yep.
I was trying to figure out what stocks I should buy with the small amounts of money I had. So I said to myself, well, why don't I look at what the professionals have to say? You've got these professional Wall Street analysts who, well, it sounds like they get paid pretty well by the banks that they work for. They must know a thing or two. So instead of doing all my own work, why don't I just see what they have to say? So I went on to Yahoo Finance, and they gave you some information there that told you what analysts said these stocks should be at. Mm-hmm. And I decided to make this simple process where I just looked at where a stock's price was, and I looked at where the analyst said it was supposed to be. And I bought a few stocks just based on, well, these analysts think they belong at higher prices, so let me buy that. So I ended up buying Bank of America, Morgan Stanley, one of the banks. I don't remember which one it was, but one of the ones that went bust.
Were these all the banks that the people worked for? Like the JP Morgan analysts say, I think JP Morgan should be $150 a share.
Funny how that works, right? So that was my first thought process. And then I got the great pleasure of watching that Bank of America position that I bought, because some analysts said that the stock was supposed to go to like a dollar and change, and basically wipe the entire position out. And again, luckily it wasn't too much money, because I didn't have a lot of money at the time. Mm-hmm. But I said, what the heck is this? What's going on here? And now, as the traders on my team know, I just have the worst disdain for those Wall Street sell-side analysts. All they do is chase price. We see it every day. It's so bad. Like, oh, the energy stocks are going up. Okay. Right. Here, a week later, here come all the upgrades. Oh, look, the growth stocks are going down. The same growth stocks that they were all upgrading back at the end of 2020, when they were going through the roof and basically having bubbles. Now they're going down. So let's have some time for the analysts to downgrade all of them. And it's just like, it's such a joke.
So one of the things that we've always thought was that the analysts basically exist to drum up interest for the institutional trading. Yep. If someone's telling you that Bank of America should be valued much higher than it actually is trading at, that's because institutions are holding a bunch of shares that they need to get the hell out of.
Yeah. Yeah. They're supposed to be, they're supposed to have, I forget what the new term is, but they used to call them Chinese walls back some years ago, where, you can't have the analyst speak to the investment banker and things like that. Mm-hmm. But it does always seem like the analysts do things that are in the best interest of the bank itself.
Right.
Just I have no proof of that, just from, looking at it from the outside based on seeing the upgrades and downgrades every day.
It just seems that analysts in general have an ulterior motive for what they print, is all I'm going to say.
Yeah. And when you think about it, Charlie Munger says that the older that he gets, the more he understands incentives drive everything. Mm-hmm. And that's one of the things that I always preach to the traders that I work with as well. What is the number one incentive of a hedge fund manager? It's not actually to make money. That's his number two incentive. His number one incentive is to raise as much money as possible. So he's going to do things that can help him do that, even if it's not necessarily in the best interest of performance. What's the number one interest of an analyst that's on Wall Street on the sell side? It's not necessarily to provide you information that's going to give you a good investment. Mm-hmm. It's to make sure that they're as right as possible, so that they are able to continue to have their jobs and keep getting that nice, six-figure paycheck that they're getting year after year. Mm-hmm. So it's just stuff to keep in the back of your head.
So I think we kind of went off the rails a little bit there. So the differences between being a prop trader and just an everyday college guy trading.
Oh, yeah, that's right. Sorry about that. So right. You get me started on one topic, and I can just keep going on it for you.
If it wasn't interesting, I'd stop you.
Yeah. So that was basically the initial thought process, is knowing absolutely nothing. And then when I graduated, I became a sales trader for a couple of years before I joined T3 and got into prop. Mm-hmm. And on the sales trading side, basically I was acting as a middle person. I was speaking to someone an institution on the buy side and speaking to an institution on the sell side. And this was during the financial crisis as well. So it was primarily, distressed instruments.
Mm-hmm.
And basically, I just wanted to get them to match on price to create a commission for the company that I was working for. And it left me a little bit unfulfilled because I wanted to know the why behind the actions.
Right.
Why is, if these are both institutions, these are supposed to be some of the smartest folks that are out there, why is it that this institution needs to sell this product or get it off their books at any fire sale price? And this other institution is looking at this as an opportunity to be able to come in and get that fire sale price for an asset that they think is going to be worth more over time.
Mm-hmm.
So I wanted to know more about that thought process. And long story short, that's what led to me getting involved in proprietary trading. I didn't just want to be on the phone with clients. I wanted to be the person who was the decision maker. I wanted to be studying and analyzing the market, figuring out how to manage risk and coming up with my own why. And when I first got into the business, I worked with a group of people that focused entirely on day trading. So that's how I started. I probably didn't keep a position overnight my first couple of years in the prop business. It was all very short-term trading that was highly leveraged, a lot of old school tape reading tricks, which honestly don't work anymore in 2022, but still worked a little bit back, 10, 12 years ago. Mm-hmm. And that's how I first got involved, but really doesn't, regardless of your time frame, the same principles are going to be true about money management. So, I was working with people who are implementing the exact same strategies that I was looking at, but they weren't able to be successful. And I would ask myself why, and it's, well, they let their down days get too big. Mm-hmm. Or if they had a winner that was on their side, even from a day trading perspective, they wouldn't ride it properly to be able to make money. So it was certainly a learning process, and the market taught me a lot because the market's evolved and markets changed, and I had to change my strategies over time. But what I tell people is that you should never learn from just one source. Like T3 is great, T3 Live is great. You can learn a ton from the company that I work from. It's a great starting point. Mm-hmm. But I say learn from as many resources as you can get your hands on. Learn from every book you can read. Learn from every seasoned trader that's out there. Most importantly, every trader is going to have to learn from themselves. You learn from your own mistakes, your own successes, what works for you, what works for your personality. And that was one thing I started doing very early on in my own professional prop trading career, was just keeping statistics, keeping journals, and I would study for hours and hours and hours the things I did right and wrong in the market to try to improve upon it. I was the first person to get to the office every day. I was the last person to leave the office every day. I'd be there for at least 12 hours, unless every once in a while I would, if I saw like one of the really good senior traders who, makes and loses hundreds of thousands of dollars leaving the office ahead of me, I would like fake shut down my computer just to be able to catch an elevator ride with that person to pepper him with a few questions as if I was actually leaving.
Smart.
And then I'd go right back up into the office and get right back at, my review. Sunday would come around and I would do a review of my week and build out these weekly journals. And I would spend anywhere from 2 to 8 hours on a Sunday just reviewing every single trade that I took with an objective mindset because my P&L wasn't in front of me anymore and things like that. And, it was just a lot of putting all that together over the years that got me to kind of where I am today. Speaking to you guys.
That's a secret that we figured out is if you start a podcast, you can talk to all those people.
Yes.
They'll actually come to you most of the time. If
Awesome.
you do it long enough.
We're the porter in the elevator that's pressing the buttons for them.
Exactly.
Nice.
So how long were you doing the prop trading before you moved on to creating your own basically curriculum is what it sounds like?
So I had been prop trading on my own for basically 3 years, but within the second half or so of that 3 years, some of the managers that I was working for were saying to me, hey, Derrick, you're doing well. Do you mind taking a trader or two under your wing just to coach them a little bit? So I had already started to get that exposure there. Mm-hmm. And I enjoy teaching. Going back to the martial arts thing, I've been teaching martial arts for 20 years. So I think that's helped me to be a good teacher since I've been doing that for so long. And that's another thing that just translated well. I did well, I guess, working with a couple of people. And that's what led to me, along with my own trading, having the opportunity in 2013 to then officially be able to start my own trading desk and officially have traders that were under me that I was bringing into the company and I was going to be responsible for their success.
You mentioned that you had, was it like 150 traders now that are working for you that you're managing? Is that the right number?
Yep, it's somewhere around that number. Yeah.
What's the typical success rate of the person who tries to get into that? Like, how many of those people did you have? What did you start with to get to that number?
Sure. That's a great question. This is a really difficult business. And that's one of the things that I'm always really upfront with people about. Not everyone who pursues to become successful, even, if you join T3 Trading Group as a professional trader, I promise I'm going to work my butt off to try to get you successful. So will T3. I promise that you're going to learn a lot, but I can't promise that anyone will actually be successful and be able to turn this into a career, because you're going to be making all of your own choices and all of your own decisions. So success rates vary pretty dramatically, I think, based on a couple of factors. One is the type of background that you're coming from. So I've got people on my team who are former hedge fund managers, floor traders, pit traders, guys with decades of trading experience. And I've got other people on the team who are recent college graduates just getting their career started for the first time. Obviously, the person who's got 20 years of experience, even if it wasn't directly in prop trading, but they were an asset manager of some sort, and they're coming into this business, is going to have a higher probability of being successful than the person who is, just getting out of college and just starting for the first time, which doesn't mean that person can't be successful either. It's just that their learning curve is so steep. And that's why, by the way, not to get off topic again, stop me if I get off topic. That's why risk management is so crucial for everyone, but especially that entry-level trader who's first getting started. I can count on probably one hand over the 12 years that I've been on this business, the amount of entry-level traders I've seen who are profitable their first one trade. It just tends to not really happen. It's such a big learning curve. You don't even know what you don't know. If you're 2 weeks into a professional career. It really takes a solid 9 to 12 months just to get through the mechanical aspect of the learning curve before we start even getting into psychology and things like that, just to learn all the different mechanics that are necessary for success in trading. So that's going to be one factor. Another factor is market environment. They generally say in prop trading that the success rate's 5%. And I'm pretty confident that I've been able to beat that over time, but year by year is so dramatic. You take a year like 2015. 2015 was the most difficult trading year that I can remember. The market basically went sideways in a really tight range almost all year. We had neither direction nor volatility. We tend to really need one or the other, or ideally both, to be really successful. We had almost no direction the entire year 2015 until August 24th, 2015, when China had the little yuan crisis there that caused the market to have that just insane, almost mini flash crash on that day, which, don't let me get off topic. But you take a year like that, it's very hard to get an entry-level trader successful. Then you take a year like, a 2020 or a 2013 was another one that was a lot easier. And 2020 is when a lot of people first got into the business, and the market was just so forgiving on your mistakes. You make a risk management mistake in some garbage company and you hold it against you. Next thing you know, it becomes a meme and it's flying all the way up, and you're making all that money back from your mistake plus a lot more. So if you get started in that type of environment, it's going to be much more conducive to making money while you're going through your learning process.
So what were some of the common traits that you find with the entry level? I mean, obviously the people who have 20 years of experience are ahead of the curve, but when you grab a guy who's straight out of college, what are some of the common themes that you've noticed among the people who are successful?
Sure. Discipline and work ethic would be the first two things that just come straight to my mind. Discipline is really multifaceted. First and foremost, what I keep preaching on is discipline in regards to risk management and money management. But really, it's discipline about rules, because everything is about the rules that you set. You set money management rules for yourself. You set risk rules for yourself. Then you have to have the discipline to follow them. I always feel like in a phone call or on a podcast, it sounds so easy. I'm going to make a rule for myself where I never lose more than $500 in a day or whatever. you know?
Yeah.
Then the numbers are moving, and then, oh my God, am I going to get out right here? I think it's going to be the bottom. I can't get out right here. I can't exit this position in this moment. This is going to be the absolute bottom, and I'm going to get out, and the stock's going to go up, and then what? You know, it's about the long run, because trading is a game of probabilities. In the long run, every single possible thing that can happen will happen. You're going to have the trade where you buy the high tick and sell the low tick. You're going to have the trade where you get shaken out at the low and then it works beautifully. You're going to have the trade where you don't get stopped out by 1 penny and then the trade works out great.
We don't remember those, though.
And that's exactly right. That is exactly right. And that's actually one thing I go out of my way to do. Whenever I'm doing one of my team's afternoon meetings and it's one of those occasions where I barely didn't get stopped out of a position, I always really make sure to bring it up, because traders all the time will start moaning and groaning about, oh my God, I can't believe this stock stopped me out.
I never get the luck.
Yeah, I never get lucky ever. And it's not true. You do get lucky sometimes. It just doesn't stand out in your brain because it's not nearly as painful as getting stopped out at that absolute low.
Right.
So I actually go out of my way to point out, oh my God, look, I didn't get stopped out by 2 cents in this trade and it worked great and it's my best name on the day. And, you know, the opposite happens sometimes too, but we have a recency bias, which can negatively impact our thought process for trading. And it's just going to be, in the long run, every possible scenario that can happen will happen over time. But the only way that you can have consistency, to go back to the original question before we get more off topic, is to have discipline with those rules on everything that you do. You know, Here, I think, is a great takeaway for any of your listeners. We all want to be consistently profitable. Well, the only way that you can be consistent is to do things consistently with the market. And the only way that you're going to be able to do things consistently with the market is to have rules that enable you to do that. If you're coming in and you're doing one thing this day and one thing the next day, and you're changing your risk management rules and you're just getting out of this position because it went up a little bit and you feel like it, that's not following a set of rules that are going to breed the type of consistency and approach that actually can create consistent profitability. It's almost like profitability is like the back end of it.
Right.
It's really not what's that important.
Being profitable is the reward of good risk management, I think, is the saying, right?
Exactly. You just got to follow your rules consistently over time.
Speaking of rules, like, what are some of your big ones then?
Sure. So my rules are, I've got rules for pretty much every single scenario that you can think of. Every single trading scenario I could find myself, I have rules in.
Do you have cardinal rules?
But I've got some broader rules. They come down to game planning. Game planning is a really important part of it. Game planning starts with risk management always, and then reward maximization after that. But you'll have to develop game plans for yourself where the risk, reward, and probability of success come to play that can make it so that your winners are bigger than your losers. And that's important because most successful traders I know, by the way, are actually wrong more often than they're right.
About 40%, I think, is the around the industry average.
Yep. I know a few traders out there who can actually be consistently profitable with a winning percentage of their trades and just making 1-to-1 on their risk, but that's very few and far between.
Yeah.
Most of the time you're going to be wrong more often than you're going to be right, and it's your risk reward that actually makes up for it. So you have to have rules in place, first of all, for the downside. How much am I going to lose in this trade? You need to know that before you get into it. How much am I going to allow myself to lose over a series of trades, whether that series of trades comprises a day or comprises a week or whatever it is. And then you have to have rules for the upside also. So the number one reason why traders don't succeed is because of that failure to manage risk that we're discussing. But I do also see traders occasionally who don't succeed, who actually are good risk managers, but they're not there for the reward. And I'll go and I'll look at their track record with them or whatever, and it's like, well, you know, you do a great job never letting yourself lose more than that $500 in any given day, but you never have a day where you make more than $300 in a given day. These numbers just aren't going to work out. And they're like, oh yeah, you know, as soon as I see myself making money, I just want to book it. I don't want to give it back. Right. They have that saying in trading, you don't go broke taking profits. I don't agree with it.
Yeah.
You can go broke taking profits, because if you can allow yourself to lose $500 in a day and you're taking your profits as soon as you're up 300, you're going to go broke. It's not going to make sense.
Right.
You know, so you got to put yourself in the position to have rules for reward maximization, rules for individual trades. And for me, I break down trades very broadly into two major types. There are counter trend trades and there are with trend trades. I guess technically you also have range-based trades. I kind of put that more in the counter trend category than the with trend category. But your basic principle here is that trends tend to last much longer than people expect they will. So if you are counter trend on your trading, that inherently means that your reward will almost always have a cap on that.
Right.
Unless you are some sort of god of trading and you're much better than me and you can perfectly pick every top and bottom that comes in the market. I'm yet to meet that person.
No. I don't think he exists. Unless he's making the market. Maybe Powell?
Yeah, or never mind. I'm not going to go there.
You can go there.
I know, right?
The compliance department might be upset if we start talking about politicians. To go back to what we're talking about, if you're with trend and you go by that same principle that trends can last for much longer than anyone ever expects, if I'm long a stock and it's trending higher and it's at all-time highs, what's my reward potential on that trade? It's infinite.
Right.
Obviously infinite reward is just like not real, but one of the best trends that I've ever personally run in my trading career was starting in 2014. I got long Microsoft because Steve Ballmer was out, who I thought was a terrible CEO, and they put this guy Satya Nadella in. And I'm listening to him, and this goes back to incorporating fundamentals with your technicals. I'm listening to things he's talking about as he's a CEO about how he wants to transform Microsoft, get away from the traditional Windows business and start to focus on cloud and artificial intelligence and all these new future technologies and businesses. Yet they've got the backdrop still of Windows and Microsoft Office as a core business there that's just a cash flowing machine for them. And they're going to take that and they're going to try to build an empire of a business off of that. And I said, man, I really like how this guy's talking. Mm-hmm. And I looked at the chart. The chart had been going sideways for 10 years under Steve Ballmer. And I'm looking at this, testing this resistance level for this breakout, shortly after Satya Nadella became CEO. And I took a simple breakout trade. Well, I implemented my reward maximization rules on a swing trading basis on a weekly chart that enabled me to ride a weekly trend. Mm-hmm. And if you go look at a weekly chart
I'm
of
looking
Microsoft.
At it right
now. If you look at a weekly chart of Microsoft going back to 2014, and you know exactly what my trailing rules are, I've got 3 trailing rules. If you follow my rules on that weekly chart, you don't get stopped out of Microsoft until COVID in 2020. Yep. That's a 6-year trend. You think when I bought Microsoft as a breakout in 2014, as much as I liked what Satya Nadella was talking about, that I thought I could potentially hold this thing for 6 years? Well, there's your risk reward.
Even better, you got past that year mark too, so they're long-term gains.
Yep, for sure.
Yeah, that's a hell of a trend.
Yeah, great company. Still my favorite company in the market, even though I don't have a position in this moment.
Well, let's talk about managing the runners, actually. I want to hear a little bit more about that. That's one of the things that I usually end up having trouble with. I'll usually get 3 to 5 lots on an option contract. They'll start going my way around 20 to 30%. I like to take my first trim. That kind of moves based on, structure.
Sure.
But then the next 2 runners that come out after that, like say I take, 60% out at, 30%, then I've got 2 more runners left to go. They usually end up getting taken off pretty soon after that because what you said, like I don't want to give back gains. I try to pick structure for it, but then that always ends up being the low of that move and then takes off again after.
But at that point, what does it matter? You've already booked so much of your position and you've got this little runner that's left. What does it matter if you give back a percentage of what you've already made in order to make more on that?
It really shouldn't. It's just I usually end up either closing it out too soon or getting stopped out before the continuation move.
Sure. So there's nothing wrong with booking a percentage of your position as profit. And I like to sell a decently large percentage of my position very quickly on the trades that I'm in to cover my risk.
Yeah.
So I like to get to a win-win situation where, as soon as I know that my worst case scenario, unless there's some sort of crazy overnight news event and I'm holding it overnight or something like that, I want to know that my worst case scenario on this is at least 0, if not better.
Yep.
And once I hit that point, that is when I become what I like to call strategically greedy. Like I don't want to just be greedy all the time, because that sometimes can cause you to not make any money. But
right.
When I'm in a win-win situation, the risk is covered. Well, this is where I really need to do everything I can to maximize my reward. So I still might, do what you were describing and take a percentage off at the next resistance level, or just purely based on, risk reward math. I'm 5 to 1 in the money. I'm 10 to 1 in the money. I'm just going to book a little bit. Or sometimes I like to, if it's like a long position as an example, and it gives me a really fast move in a short period of time on momentum, so it gets extended to the upside, I like to just book a little profit into that extension. But if I'm with the trend, I really don't want to ever get out of that last bit, that last, let's call it, and it's going to depend a little bit on the trade and how much like the daily chart, but anywhere from 10 to 40% of my initial position after I'm really in that win-win situation. My goal is to follow rules, of course, that will enable me to get stopped out, but I want to be able to hold this position for as long as physically possible and let it continue to pay me, because I actually hate putting risk on, which sounds crazy because it's what I do.
Do it every day.
That first time when you press the button and you might lose money, I hate that.
Yeah.
I don't like losing money when I first press, but I don't want to do that. But if I've got this position that I will potentially, I'm willing to give back significantly more P&L than I'm willing to actually put on initially as risk, if that makes sense.
Yeah.
Because I'm in that win-win situation and I just want to maximize this, and I want to be able to follow these rules to let it continue. So I have 3 rules for trailing. I trail based on a pivot low. I need the ADMA to have caught up to that pivot low, and I need a new high to come in. I speak to a lot of retail people, and maybe they're interested in becoming a professional prop trader or whatever it is. And I love to ask them, okay, well, tell me a little bit about your own personal trading that you've been doing. And, there are no wrong answers. I just want to learn about your thought process and what you've been implementing. I can't tell you how often people tell me, oh, I just use a trailing stop that's based on a certain percentage or based on a certain dollar amount of what I'm up or something like that. But the market doesn't care about that information.
Yep.
The market doesn't know that you're 10% of the money and only willing to give 2% back. That's not what's important to the market. You're making when you're doing things like that, you're making decisions that are important to yourself. What you need to be doing is making decisions that are important to the market.
It's funny. I think it took us 6 months to learn our lessons with trailing stops.
Yes.
At least. But I've never put the thought together like how you just said right there.
Right.
Making your decisions based on what's important to the market.
Rule number 1, I got a pivot low. Well, what is a pivot low? A pivot low is the actual spot in the market where buyers took control from sellers. Or if it's a downtrend, then sellers took control from buyers. Just think about up for the moment because it's easier thought process. So I've got this pivot low that comes in. That is the actual spot where buyers took control from sellers. That's significant. And then for me, I use an 8 and 21 EMA in my charts. My charts actually are very simple. I use Japanese candlesticks, I use volume, and I use a handful of moving averages that are really important to me.
Volume profile or just regular volume?
Just regular volume. I don't have any other advanced indicators in there. It doesn't mean I don't pay attention to the information when it's provided to me. I absolutely do. But I think that traders, especially new traders, very easily become overly dependent upon indicators, and that they need to remember that all an indicator is something that indicates something. Like literally, an indicator is something that indicates that something could happen based on other metrics. So I like to, if someone provides me information about any type of indicator, it's what I call a layer of probability. Well, because you're telling me that this indicator is saying that the stock should have a bounce here or whatever, that doesn't mean that it has to happen. It just means that there's a slightly greater probability that it will occur.
Right.
So I like to use just a couple simple moving averages, the 8 and 21 EMA. in an uptrending stock, I consider the ADMA to be what I call the upper band of technical equilibrium for the market. So if the stock is trading well above that ADMA, then it is technically extended to some degree. And if it's touching that ADMA or it's pulled through it, it's somewhere between the 8 and 21 EMA, it's in what I would call kind of technical equilibrium. So that's trailing rule number 2. So I need my pivot to occur, but I don't want to raise my stop to an extended pivot. If the market is extended and I'm putting my stop loss there, there's a very high probability that I'm going to get pushed out of that position. There's actually a very high probability that I'm going to get shaken out of that position and it's going to continue higher without me. But if the ADMA has caught up to that pivot and the stock is trading at some price above it, there's a much lower probability of a shakeout actually occurring. So that's rule number 2. And then rule number 3 is I want a new high to come in, because what's the definition of an uptrend? It's a pattern of higher highs and higher lows. How do I know that this is the pivot low of an uptrend if a new high actually hasn't come in? I don't have confirmation yet. So when all 3 of those rules confirm, then I can raise my stop to that next low that came in, and I'll just continue to do that over time. One thing about trailing that I think it's important for people to remember is that, and this is sometimes tricky psychologically, if you are trailing a position, you will never get out at your P&L highs.
Yep.
Every trader wants to get out their highs. Every trader, you could be having the best day of your career, but you gave back, a couple $1,000 or whatever at the end of the day, and you're like, dang it, man, I can't believe I didn't close at that other prettier number that I had earlier that I wanted to be up. So if you're trailing, you're inherently going to be giving money back, but in the long run, if you're with the trend, this is probably going to be better for you.
Do you ever add to your positions? You get your initial position, it takes off in the direction that you want, it comes back down into some rotations. Do you ever go in and add to it, add to winners?
Sure. So I define 2 different things with the team that I work. There's adding and there's adding back. Adding means that I had 1,000 shares of a position, and now I've added to it that I've got 2,000 shares of a position. Adding back means I had 1,000 shares of a position, I took off 200 of it, it pulled back, and I'm putting that 200 back on. The difference is that adding is adding risk. Adding back is taking my risk back, but keeping the difference on what I sold and what I bought back.
Right. Yeah, you're still realizing something there.
Right. So I always want to differentiate between those 2 things. And I do both. I love doing the adding back thing. If I see, a lot of what I do is I do swing trading where I actively day trade around a core swing position, where I do a lot of what I'm describing right now, where I get this great, nice, fancy move on a 5-minute chart. So I take a little bit off and then it pulls back into that equilibrium zone and I put that stock back on, where I take my risk back, but kind of keep the difference. That's adding back. Adding to me is a whole different trade. So if I've got this breakout trade, whatever, or I got 1,000 shares of it and it's working great, and now there's a bull flag that's forming, and I take this bull flag trade, and now I'm putting on another 2,000 shares, they might as well be 2 different stocks for me. I'm not going to let the new add of a bull flag trade where I'm putting on that risk negatively impact this other 1,000 shares that I'm really nicely in the money on. They might as well be 2 different companies where I'm saying, okay, I'm going to put this extra risk on this other trade. If I get stopped out of it, okay, fine. Then I still have my kind of core position here.
Right.
That's another thing that really messes traders up, even though it's just accounting math. And the math always works out to be the exact same. Like, how do you have your system? Is it calculate? Did you just mess up? Oh, but what if I mess up my average price? Well, it doesn't actually make a mathematical difference if you look at the numbers and study them on whether you're using average price or whether you're having like 2 separate trades from 2 separate prices, if you follow what I'm saying.
About you, Dan, you got anything you want to ask? We got an options expert here, since you're taking more time there.
Yeah, since I'm the one that actively day trading options.
Yes.
Well, he's really covered a lot of the things and questions I had, especially the thing about runners. That was my issue today, was aggressively moving the stop of my runner. And if I'd kept it in place, the trend continued, and I really missed out on doubling my gains for the day.
Right. That's something that's been that I've been wanting to get an answer to, or a little bit more, I guess, explanation of how to do that properly.
Yeah. I think we should move on to some of the listener questions.
All right, what we got?
The first one is, when is it better? Is it better to use naked options, and when is a debit spread better?
Sure. So I don't personally trade options would be the first thing that I would throw out there. So I may not be the best for giving advice on this. I am specifically an equity trader.
Oh.
And I can talk a little bit about why I trade equity and I don't trade options if you'd like. And then I could try to answer your question.
I would actually, I would like you to speak on that.
Yeah, I'm sorry. We thought you did. We thought you were more options.
Nope, I don't trade options pretty much at all. I pay attention to them. One of the things that my team and I like to pay attention to, not to get off topic again, is large order institutional option flow that hits the market, because it can act as a really strong layer of probability for what's going to happen next. And that's kind of one of the best ways to get an idea of, what the big money, what the big institutions are doing, is by seeing those large orders hit the marketplace. So the reason why I don't trade options, I'm a professional proprietary trader. So I'm not limited to retail regulations that you have to deal with, like Reg T or even portfolio margin for larger retail accounts. In theory, the company can give me access to as much money as I want. So most of the professional prop traders, we usually start in T3 Trading Group. You post up capital as if you're funding any other account, but we give you access to 20x your capital for equity day trading and 8x your capital for equity overnight positions. And then you're paid based on a profit split. So that's a lot of what we do. So I don't have to worry about margin calls. I don't have to worry about, Reg T, 4x, 2x, and the clearing firm, marking that down even further. So my thought process has always been, why do I want to trade options, which are a less liquid product and subject to time decay, just for extra capital access, which is the primary reason why retail traders are in options,
right?
When I already have as much capital access as I could ever want. So I don't trade options for that reason. Now, I do have options traders on my team. The primary reason why someone would trade options if you're on my team and you have that capital access is really one of a couple of reasons. One is that you're implementing some sort of complex option strategy, like a spread, like the question had just mentioned, that can't really be replicated in the equity market. It's a very specific strategy to options. Or some of my, bigger swing traders will, self-covered calls just for cash flow and hedging purposes. And that's pretty much the extent of it. But for the most part, for a directional trader like I am, I don't really have any need or honestly any desire to trade options. But I can answer one thing about his question. I don't like the naked selling of options, specifically if that question was geared towards naked calls.
Yeah.
It's a great way to make a few bucks and then have no money. So, if you're implementing, some sort of spread strategy like that, where the risk is defined and you can build out an approach and you can, really understand the math behind it and you create rules for it the same way that I was discussing earlier, that's what I would go with for the listener.
Well, one of the things I think that I liked about naked options, not necessarily selling them. I mean, whenever I sell them, they're always either cash secured puts or covered calls. But it's one easy way to cap out my risk. I know my risk is defined as the maximum cost of the contract.
Yep, that is feedback I get from people a lot as well. I would say that I know my maximum risk because my maximum risk is defined by where my stop loss is.
But if you're holding them overnight,
right? So that's exactly what I was going to say. There's a couple exceptions to that. One is overnight holdings, which is why I preach that you should. It depends a little bit on the stock, but I preach that for overnight equity holdings, you should always have a minimum of a 1% profit cushion on an intraday basis in order to keep that position overnight, in order to help mitigate, especially in this crazy volatile market we've been in right now, to help mitigate the downside on that. Another time where I think that options actually are your best bet, even though I don't personally do it, is if you wanted to take a bet into an earnings report, because you know exactly what your risk is on it, and you really can't do that on equities. But you got to also remember that taking a bet on an earnings report is exactly that. It's a bet.
It's gambling. Yeah.
It's gambling. You have no idea. But if you wanted to take that shot, you're much better off doing that gambling where you know exactly how much you're going to lose because you've got an options contract than just, hey, you know what, I'm going to buy 1,000 shares of Shopify here into this earnings report and hope I get lucky.
And hope that IV doesn't crush you when that earnings report comes out.
Yeah.
Right.
Well, shit, that's going to kind of make it hard to ask these questions then, huh?
Yeah, the listener questions are out.
Well, I think we can modify this one. So when you're looking at a stock that is sitting near all-time highs or all-time lows, like how do you set your profit targets? The question was more like choosing strike prices when the underlying is near those levels. But
Sure.
if you've got a stock that's broken out into an all-time high and you're going long trying to ride the continuation of that, how would you pick those targets? Do you use fib retracements or?
No, I don't believe in magic numbers.
Magic, that's science.
I got a great story about one time when I found myself selling magic rings at the side of the Great Wall of China, but we can save that for another day if you want.
Sounds like a good thing to end on.
So on the upside, again, I go back to the thought process of if I'm looking at something that's at all-time highs, there is no maximum on that, right? So that's where the trend following rules really kind of come into play, and implementing, what we were discussing earlier to really maximize the reward on that. You can pay attention to extension rules. I think extension rules are important. When stocks move up too fast, and how much that is varies based on the type of company that you're looking at, and kind of how you're measuring your extension. But you can even just look at the end of 2020, early 2021, when we were in the growth stock bubble there. Just things were getting so out of hand with how extended they were on the upside, and people were still chasing price. It was just it wasn't going to end well. And then, on the downside, the question was buying stocks that are at all-time lows? Was that the question?
Well, it was choosing targets, basically. So you want to know how to choose a strike price when the underlying is near an all-time high or low.
Got you. So I guess on the downside, it depends if you're trying to make money long or short. If you got something on the all-time low there, are you picking a bottom and getting smelly fingers, or are you looking for further continuation to the downside there? And again, look, there's nothing wrong with strategically looking for a stock to kind of bottom out. And I've done that now more recently with some of these growth stocks, as I was just talking about them being in bubbles, whatever, a year and a half ago at this point. You can do it, but you got to do it strategically, and you got to have your risk management in place. As a general rule, if you're looking at a stock that's at all-time lows, you don't want to catch a falling knife. You want to try to buy it on the way up. And there can be rules that can enable you to buy stocks on the way up based on when you see certain things. But otherwise, if you're short, then sure, your target's zero, I guess.
Ride it into the ground.
All right. Tell us about China now. Selling magic rings.
Yes, selling magic rings in China at the Great Wall.
I had so I've been to China a few times before COVID hit, and I've always had really great experiences there because I've had some traders on my desk in the past at T3 Trading Group who were from China, got great educations here in the United States, but eventually ran into visa issues that caused them to go back. And one person in particular, he started his own trading company out there. Another person started his own hedge fund company out there, and they started by working with me. And they were really gracious on a couple of occasions to invite me out to China to give some lectures, or to give them some advice during the business formation of what they were doing. And was happy to oblige, and they just gave me these great experiences, showing me the whole country. And the one time when I got to go to Beijing, they took me to the Great Wall of China. The Great Wall of China is incredible, but the first thing I would say is when I first got there, I thought it was the worst place I've ever been to in my life, because it was a summer, hot, sunny day, and I was in a very crowded area.
Ugh.
And all the women use umbrellas to keep the sun off their head. Well, from America, I'm 6 feet tall, so I'm tend to be probably a little bit taller than the average, Chinese woman. So they happen to hold all of their umbrellas right at my eye height.
Yep.
So I'm like trying to get up the Great Wall of China. I'm like batting off umbrellas left and right. Eventually we got away from the crowds, and it was just an incredible opportunity. We just walked for miles and miles and miles. Like it was a really beautiful, awesome experience. We found like a random illegal beer cellar on the wall, and we bought some beers from him that we were drinking. Just a really cool experience. But when we go to finally leave, we accidentally left the wrong part of the wall, and we were just in like an entirely different mountainous region that I guess was miles and miles and miles away from where we parked the car.
Tibet.
So the guy, and keep in mind, I don't speak a word of Chinese.
Right.
The guy that I'm with is like, all right, let me go try to figure this out. Next thing I know, he's talking to some vendor there at the side of the wall, and he looks at me and he goes, okay, this guy agreed to try to go to the road to get a cab for us, but we have to stay here and we have to watch his shop. And it was like, one of them outdoor tables where they sell stuff, and he was trying to sell these magic Chinese rings. And you guys know what I'm talking about, right? Those steel rings that you like
the mood rings?
No, the steel rings that
like the puzzle game.
Yeah,
okay,
exactly.
okay.
Like magicians can bang them together and they're steel, but all of a sudden they're combined, type of thing.
Right. Yeah.
So I've got, and I say to myself, you know what, this guy's doing us a favor. We got to try to get some sales for him. So I got in my one hand, and he had the dummy props out, and the other ones were in the box or whatever. I got in my one hand the completed rings that were magic rings that were combined, and I've got also 2 rings that aren't combined yet. So I'm like, and here I am, this American yelling at people in English at the side of the Great Wall trying to sell these things. I'm taking the 2 rings that weren't combined yet, and I'm clanging them together, and I'm like reaching behind my back and taking the 2 that already were together, and then I'm like, and then see, you can make them look like this, and they're combined, like it's magic. You got to just be able to do it yourself. And eventually I like get a sale to probably like some like 14-year-old kid. Like he comes in and he buys, and I'm like so pumped, like, yes, we got a sale. Like this guy is doing a favor for us. He's going to be super pumped that we got a sale for him. And then a little while later, the kid's mom comes back, and again, I'm assuming in Chinese, she's like, hey, you sold these magic rings. They don't work. We don't know how to be able to put them together. And I'm like, well, I don't know how to be able to put them together either. Luckily, just at that moment is when the vendor came back, and he was able to make everybody happy and get the sale from there. But definitely a cool experience, and I still don't believe in magic or magic numbers to this day.
Even when it's a trick, that doesn't really work.
It's all a trick.
It's all a trick.
Well, it looks like we're coming up on the end of the day, unfortunately, Derek.
All right. Well, Dan and Kyle, I'm glad you guys had me. It was a good time.
I had a blast talking to you. You want to let the listeners know where they can find you?
Sure. So I'm a professional trader with T3tradinggroup.com. Or T3trading.com. I'm a professional trader for T3 Trading Group. You can also find me at T3Live.com, which is our education and media company. And I've recently started my own YouTube that you guys can give a subscribe to. If you YouTube Derrick the Trader, my first name is Derrick, Derrick the Trader on YouTube. I just created this YouTube channel recently. I'm getting a lot of cool little mini trading lessons in there. And I've been broadcasting my team's 4:10 p.m. afternoon meeting live through there.
Oh, that's cool.
Monday through Thursday recently. So you guys can check that out to get an idea of, what my team of professional traders and I are talking about on a day-to-day basis.
Are you on the Twitter or any of those?
At ProDesk VTF.
ProDesk VTF?
Yep. The ProDesk virtual trading floor is the virtual trading floor that I manage through T3 Live. So at ProDesk VTF on Twitter.
I'll make sure there are links for all those things in the episode description so people don't have to try to memorize everything.
Yeah.
Awesome.
All right, Dan, you want to take us home?
All right, folks. Thanks for joining us today. We hope you learned a lot. I know I did. It's been a great time, Derrick. Thank you again for coming by. Great content.
Thank you.
And as always, you don't have to go home, but we're closing up the shop, so you got to clear on out. Until next time, happy trades.
Bye.
See ya.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks and the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.
This episode is brought to you by Grant Thornton. You may know them as an audit, tax, and advisory firm that's part of a global member network with over 60,000 employees. But they do more than numbers. They're the listening ear and fresh perspective you need to turn today's challenges into opportunities. Kind of like a podcast, if it was just for you. Learn more at gt.com. Copyright 2022 Grant Thornton LLP. All rights reserved. U.S. member firm of Grant Thornton International Limited in the U.S. Visit gt.com for details.
Good news. You started a company. Now you have to run it. When you look out into the sea of CRMs, it can look extremely blue. But HubSpot is here to give your company a more human approach. We're a CRM that's easy to use, aligns all your teams seamlessly, and delivers a better experience for your customers, so your business feels like a helpful partner and not just some company trying to force a sale. There's a better way to help grow your business by connecting your people, your customers, and your business. HubSpot. Grow better.